Assalamu alaikum and welcome to lecture 15. You will be very happy to know that this is the last lecture of your IHT. So the first lecture was lecture 13, 14 and 15. These three lectures are very important for IHT. I started with basic IHT, then we went through specific valuation rules and the death state, and lecture 15 is the balance of IHT. So with this will conclude the IHT before we move on to a new type of tax, another tax. So here we are going to cover the overseas aspect like how I have done for income tax and CGT, overseas aspect, administration and tax planning. Overseas part I have done for income tax and CGT, and it would be very helpful if you watch my uh, lectures on the overseas aspect of income tax and CGT, because that will help you in the overseas part of IHT as well. More of the things we study there applies here, like domicile, residence, non-UK domicile, terms like that. So here, I'm assuming you know those things, so I'm going to quickly go through those again, okay? So overseas aspect of IHT, this is new in ATX, so that means this part is most likely to come for your ATX exam. Why? Any new section added in ATX, not there in your taxation, are more likely to occur in your exam. That's where they will test you. Then we have double taxation relief DTR. Then payment of IHT, tax planning is new, and anti-avoidance rules gives with the reservation. Then summary. So the overview of this lecture, let's quickly go through overseas aspect, administration, tax planning, and anti-avoidance rule. This is the other areas of IHT. So I have done how to calculate life gift on the IHT on lifetime gifts when the donor dies, the impact of death, the additional tax that you have to pay on lifetime gifts, and also death state. Three areas done. Now the other parts, small areas, will touch upon them. So overseas aspect. This is nothing new to you. Any tax, whether it's VAT, corporation, CGT, income tax, all the type of taxes, overseas aspect to it. So for IHT, the individual's domicile status is a key to determine the extent to which overseas asset will be liable to IHT or not. What is domicile and all I have covered in my previous lecture. Would go to my ATX playlist. All the lectures are there in order from lecture 1 till 15. All the previous lectures are there, it's updated. Go there, watch my overseas aspect of income tax and CGT lecture. There, the domicile term has been given. So I'm not going to waste my time again to explain what is domicile and all. You can go back. I'm assuming you know the meaning of domicile. I'm going to proceed with this lecture. Okay. Domicile and deemed domicile, there were two terms. Okay. So as I told you, the definition of domicile for IHT is same as for income tax and CGT. Thank God. However, whenever the word however means, these are the differences. There are three situations in which a non-UK domicile will be considered a UK domicile only for IHT purpose, not CGT and income tax. Income tax and CGT work similar way, okay, in terms of overseas aspect, whether it is domicile or not. If it's domicile, for income tax also it is UK domicile, for CGT also it is UK domicile. But when it comes to inheritance tax, it is dealt a little differently, okay. Number one, and you have to know all these three situations. This is where you will be tested. You might be given one of the situation in your case study. First situation, UK domicile individuals who are leaving UK. So an individual has been domiciled in UK, is now moving abroad, makes a permanent home in another country, still will be deemed to be UK domicile for IHT purpose for another 3 years. After ceasing to be UK domicile, even if it's not UK domicile for 3 years, still he'll be UK domicile for 3 years. Next, second, long-term residence. An individual is deemed to be UK domicile in a tax year if the individual has been UK resident for 15 of the previous 20 tax years and at least one of the previous four tax years ending with the tax year of the chargeable transfer. Okay. Third situation, formally domiciled residents. Here they will be deemed domiciled if he was born in UK and has a UK domicile of origin and is UK resident in that tax year and was UK resident for at least one of the last 2 tax years immediately preceding that tax year. Okay. Now, so what is the effect of this domicile on IHT? If you are a UK domicile or deemed domicile, you will be charged to IHT on the transfers of worldwide assets. Same like IHT and income CGT also. If you are domicile or deemed domiciled, it's worldwide. But if you are non-UK domicile, only the transfers of UK asset will be charged to IHT. Now let us do questions. So we have 2 questions, test understanding 1 and 2. Both the question is the same. Explain the extent to which Thalia and Lucia will be liable to IHT. That means based on domicile. Thalia has been domiciled in UK since birth. On 1st June 2020, she emigrated to France with the intention of remaining there permanently and changed her domicile. She died on 31st March 2023. Okay. So, that means she ceased to be UK domicile on this date, 1st of June 2020. But for IHT, she will be deemed to have been UK domicile for further 3 tax years. That is till 31st May 2023. If you take from 1st June 2020. So she died before that. That means as her death occurred before 31st May 2023, she will be liable to UK IHT on her worldwide assets. Worldwide. Because she will be considered UK domiciled. Second situation, Luca is domiciled in Germany, UK resident on 1st May and died on this date. Now you have to calculate which rule is this? Which rule is this you have to see? The moment they mentioned about UK resident, it is long-term residence. You have to see whether they were long-term resident or not. Situation number 2. Okay, so for how many years she was UK resident? She has to be UK resident for at least 15 of the previous 20 tax years, no? For him to be UK domicile. So how many tax years? 2005. From 2005 to she died on this date, 1st March. So if you take from 5 to 2024, how many years? 18. 18 tax years. You have to take the tax years. It's from 5. So it's 5-6. 2005-6 to 2023-24. This is inclusive. You have to take this and this as well. Okay. So 18 tax years. So was resident. Sorry, you have to take till 22-23. So 18 tax years. 18 tax years he was resident. So because he was a resident at least 15 of the previous, he will be deemed UK domicile and therefore liable to worldwide asset. Okay. Now the next, location of assets. UK domicile individuals are charged to IHT on assets regardless of their location. Whatever the location, they will be charged to IHT for UK domicile individuals. But what about non-UK domicile? Only liable to IHT on UK assets. That's why we need the location of assets for them. Therefore, it is necessary to be able to identify where in the world an asset is deemed to be located for IHT purpose. We don't need this for CGT or income tax, but for IHT, we need the location of assets. If it's land and buildings, depending on the type of asset, this table will help you, okay, to decide location of asset. If it's land and building, it is the physical location, wherever it is located. If it's in UK, it's UK. If it is France, it's France. Register shares and securities, place of registration. Chattels, location at the time of transfer. Debts due to the individual, where the debtor resides at the time of transfer. Bank accounts, location of the branch which maintains the account. Life assurance policy, where the proceeds are payable. Business, where the business is carried on. Now let's do question. Test your understanding 3. In test your understanding 3, you have been given 8 properties. Okay. You have to decide, explain whether Sam is liable to be charged on IHT if he transferred his property. So Sam has lived in UK for last 6 years. However, he is not UK domiciled and is not deemed to be UK domiciled. He owns the following property. Okay. So remember, because he's not UK domiciled, not UK resident also, sorry, not even deemed domiciled, what happens? He will only be charged to IHT on his assets located in UK. Only UK, not worldwide assets. So we'll see the first situation. Freehold property situated in UK. It is chargeable. Whichever is chargeable for IHT, I will put a tick mark. Whichever is not chargeable, I will put a cross. Second, leasehold property situated in US. Not chargeable asset. It is situated in US, no? It's a property, depending on where it is situated. Physical location. Shares, now second type of asset, shares. Shares in USA Inc., a company quoted and registered on US Stock Exchange. No. Okay. It is registered in US, that's why. Antique situated in Sam's US residence. No, it is not. Because it's in US. Fifth one. Loan due to Sam by his sister who is resident in US. The sister used the loan to buy the property situated in UK. Read number 5 very properly. A loan due to Sam by his sister. Sister is resident in US. Sister is giving a loan to Sam. But the sister used the loan to buy the property situated in UK. Fifth one. See, Sam's sister is living in US. Therefore, the asset is located in US. Asset is located in US. Why? Because Sam's sister lives in US. Okay. Therefore, it's not a chargeable asset. The fact that the sister used the loan to buy a property situated in UK is not relevant. This is not relevant. It depending the relationship with the Sam. Sister could do anything. We are focused on Sam. We have to see whether Sam is liable or not. Sam is not be liable. Because the loan that Sam is getting from his sister's resident in US. Okay. A car. Sixth one. A car that was bought in US but is now situated in UK. A car is now a UK located asset. See, the car that was bought in US but now it is situated in UK. It will be chargeable. Seventh, bank deposit in sterling in the UK with the UK branch of a US bank. It will be chargeable because it is situated in UK. It's located in UK. Then next, 8. UK garment stocks, 9. US garment stocks. UK garment stocks is a chargeable asset. It's very easy. What about the next one? No, because it might have been registered in US. This would have been registered in US. Next is election to be treated as a UK domicile. If you are a non-UK domicile, but you are having a UK domicile spouse, you can elect to be treated as domicile in UK for IHT purpose. Election. So this election can be made anytime during the non-UK domicile spouse's lifetime. It's a lifetime election, remember. And it can apply from any date within 7 years prior to the election. It's irrevocable. Once made, you can't change. Okay, it's irrevocable. Why is the electing spouse is a UK resident? You can't change while you are a UK resident. It's irrevocable. But lapses, it could lapse if that spouse becomes non-UK resident for 4 full consecutive tax years. That means 21, 22, 23, 24. 4 full consecutive tax years you have been non-UK resident, then this election lapses. Then you have to re-elect again if you want to be treated as UK domicile. But while you are a UK resident, once you make the election to be treated as UK domicile, it's irrevocable. You can't change it. Next, election can be made within 2 years of the death. A death election of either the UK domicile spouse, where the non-UK domicile spouse is still alive, or the non-UK domicile spouse where the UK domicile spouse has previously died. Who will do this then? By the personal representative. They can do this election. And they can specify that if that it is to take effect from any date within the 7 year prior to the deceased death, but cannot apply before 6th April 2013. Wherever the dates are there for election, very important. Next, the election only applies for the purpose of inheritance, does not apply to any other taxes. It is beneficial where assets of more than 325,000 are transferred to non-UK domiciled spouse. Why? Because then there would be no limit to the exempt amount. See, if you are transferring to a spouse, it is exempt. It's an exempt. So why not treat the non-UK domicile as UK domicile, where you are having assets of more than 325,000. However, this advantage you have to weigh up against the fact that is a disadvantage. The fact is that non-UK domicile, if you tell them to be, if you elect to be treated as UK domicile in the future, you will be subject to UK IHT on worldwide assets. If you were non-UK domicile, you would have escaped the tax in UK. Now you can't escape the tax in UK in the future. So this disadvantage you have to weigh against the benefit of transferring more than 325,000 with that exception. Now let us do question. Test your understanding 4. So in test your understanding 4, you have to advise Lloyd as to whether he should make the election or not. That means election to be treated as UK domicile. Whenever the question advice comes, you have to do some calculations. It's very important. Why? Because without calculations, you just can't advise. You have to see without the election and with the election, what is the impact. Wherever you are saving more tax, that should be your advice. That should be your choice. So now, we'll read. Andrea, who is a UK domicile, and Lloyd, who is domiciled in Australia, married in June 2013. So he's a UK domicile, but she is domiciled in Australia. They have lived in South Wales since the marriage and have one child, Stephen. Andrea died in May 2023, leaving her entire estate consisting of UK assets valued at 950 to Lloyd. She had made no lifetime gifts. Following Andrew's death, Lloyd is considering whether he should make the election to be treated as UK domicile for IHT purpose. He intends to leave his entire estate to Stephen and made no lifetime gifts. He owns UK assets worth 200 and overseas property at 250. His estate does not include any residential property. That means no residential rate ban. Now, so first, whenever there are two things, when you have to compare side by side with election, without election, you can simultaneously do them. Make a column with election, without election. This saves a lot of time rather than doing everything with election, then again doing everything without election. Don't do that and don't waste time. Once in Excel, you can do it. So now, here, you have to consider two things. What are the two things? One, when Andrea is dying, the other one is when Lloyd is dying. Two situations, and in both whether election should be made or not, because both of them have died. So now let us quickly do that. So first we'll see on Andrea's death. He's a UK domicile. Okay. If no election is made, if election made. Okay. Now, always start with the state value. So state value, remember, state value will be same. This is for Andrea's we're talking about. Okay, Andrea. So Andrea has a state of 950,000. This one. Okay. So without election also is 950,000. With election also is 950,000. Next. Remember, it's an inter-spouse. Andrea is given to Lloyd, so there will be an inter-spouse exemption. Less inter-spouse spouse exemption. To make an inter-spouse exemption, remember, because you made an election and you in the first one you did not make an election, make a note to it. What is it? If no election is made, that means Lloyd will be treated as non-UK domicile. So in that case, interspouse exemption is limited to what? 325,000. Remember, if no election made, he'll be UK domicile. Sorry, he will be UK domicile, so it's 325,000. This will be limited to the nil rate band. 325,000. The interspouse exemption will be limited to 325,000. This is same to as nil rate band, but it's not nil rate band. Next. This is interspouse exemption. Here, because if election is made, that means he'll be UK domicile, means full 950,000 you can deduct. There is no limit. This is what you will write under the note. Wherever some exemptions are there, you have to make a note. So then it will be 625,000 if no election, and if election it is 0. Then khalas, no IHT. This is gross. You have to write these terms, okay? Gross, you just can't put a number and go with the workings. Gross chargeable state. Now, after that, what do you need? Nil rate band is 325,000. No lifetime gift. That's why it is 0. So you have not utilized anything. Full 325,000 nil rate band will be available to you. Then this is known as taxable state. Taxable state would be 300,000. Then IHT is at 40%. You did not make anything to do with charity. 40 of 300,000 is 120,000, and here IHT would be 0 because no gross chargeable state. So which one would you choose? Your should be election should be made because you are saving tax of 120,000. But do not advise right now. Advice is the last action that you have to do. Next, on when the husband dies. Lloyd's death. Okay, same. Election made, election made. So remember, on his death, there are two things you have to take care. UK asset and overseas property. UK asset separate from this one. UK asset because he's non-UK domicile. So UK asset will only be charged if it's non-UK domicile. So what was the UK asset? 200,000. Overseas 250. Overseas will only come when treated as UK domicile. Otherwise no. So 200,000 will come. UK asset will come. UK asset will come no matter what. Whether you make the election or you do not make the election. Now how much he has inherited from from his husband. Sorry, from his wife. I'm sorry. So how much he'll inherit? You see, Andrea died, leaving her entire share considered UK assets valued at 950. You see, 950 to Lloyd. But from this 950, you have to deduct the inheritance tax. 120,000. So 950,000 minus 120,000. If UK domicile. Sorry, if not UK domicile. But if he's treated as UK domicile, 950,000. Full 950,000. No tax. Because you see, you did not deduct any tax from here. Now overseas property. overseas property will not come if it's UK domicile. If no election is made, overseas property will not come. But if election is made to be treated as UK domicile, overseas property will come. So gross chargeable state is 1,030,000, 1,400,000. Now, NRB, nil rate ban. There is a node to this and there will be node next to this. See, the overseas property is only subject to UK inheritance tax if Lloyd elects to become UK domicile. That means if election is made. That's why here we have put overseas property, not here, because no election was made. Third, Andre's unused nil rate ban can be transferred to Lloyd if no election is made. If no election is made, all of Andre's nil rate ban is used on her death. Now, so nil rate ban is 325,000. No gift was made, so full 325,000 can be used. Remember, here you can't transfer because she was non-UK domicile. No election was made here. That's why 325,000 in the first. So taxable state is 705,000. On this you are charging 40%, 282,000. So 282,000. Okay. With 282, you have to add 120,000. 120,000 tax paid here from here. Lloyd's dead and Andre's death. Two dead were there. Here you are paying 120. So just add both the taxes. So total IHT would be 282 plus 120, 402,000 in the first case. Second one here. What happened? See here. $325. Okay. No nil rate ban was utilized. So it can be transferred on Lloyd's death. So Lloyd will have 325 of his own, and from Henry 325 and 325 nil rate ban will be 650,000. Transfers because election was made to be treated as UK domicile. That's why. And no lifetime gift. So 750,000. Tax at 40%, then 300,000. No tax was paid previously when treated to be UK domicile, so just 300,000 at Lloyd's death. Where are you saving more tax? This is the ideal situation. Now what should be your advice? It would be beneficial for Lloyd to make the election to be treated as UK domicile. Treated as UK domicile is the choice. But remember, when you are giving advice, don't just write Lloyd should be treated as UK domicile because he is saving more IHT and finish it. No, advice should be more lengthier. At least it should be 2-3 lines. Okay, you should give some disadvantage also. First, say saving more tax benefit. Next, you give a drawback. How will you give a drawback? In the next paragraph, you write the connecting words. However, okay, the short-term benefit. This is a short-term benefit that you are saving tax on the first date. May not be ultimately beneficial if the overseas property increases significantly in value and has to be included in the Lloyd's state on death. It could, right? So the issue is overseas property. Because if you are treating as UK domicile, remember your overseas property will be included in your death state. So overseas property, if it increases in value, your death state value will be more. because now you are UK domicile. All your overseas property also will come. So you can't skip that. So if overseas property increases, it will go where? Death state. Death state of, now it's, that means you'll have more IHT to pay in future. And the third paragraph. So now you are saying that decision has to be taken carefully. You are weighing. Rather than giving one clear-cut conclusion, don't give like that in P levels. In any P level paper, whether it's AFM, ATX, AAA, always give your conclusion like that you are trying to give the choice in the hands of the users. You are not making a choice for them by saying go by this. No, you are saying decision must be taken carefully, and thankfully Lloyd can apply the election from any date within 7 years. So because this is about election, you can give the time period, time limit for election. This you can write. When he can apply, when is the date it is applicable. Okay. So he can apply for he can apply for the election from any date within 7 years prior to making the election. So therefore he can leave the decision for up to 7 years. That means for 7 years he can leave this decision and backdate its application and come back and apply it. That means immediately he does not have to take a decision. He can wait for 7 years. This is what you can write at the end. Okay. Valuation of overseas assets. Overseas assets are valued at open market value on the same basis as assets situated in UK, but there are some differences. Number one, if the value is given in foreign currency, you have to convert it into sterling. In the exam, exchange rates will be given to you. Okay, and which exchange rate you have to use? If you are given 2-3 exchange rates, the exchange rate at the date of death. Okay. Next, when valuing, wait, so when valuing an overseas property, to include in a death state, additional expenses incurred in administration related to overseas property and expenses related to the sale of the overseas property. You have to take it, but you have to deduct 5% from the open market value, because you can only deduct the expenses up to 5%. More than 5% you can't deduct. Two types of expenses. One, admin relating to overseas property. The other one is selling. When you're selling the overseas property, whatever the expenses relating to that property. So 5% you can deduct. If IHT is payable and overseas tax has been paid, double taxation relief may be due. Now, the next is double taxation relief. This is also new for ATX, and you have a very high chance of this occurring in your ATX exam. So this applies especially when you are having overseas asset. When you don't have to deal anything with overseas, double taxation relief will not come. So this applies when asset is situated overseas. It is subject to both IHT, UK inheritance tax and tax overseas, because you have to pay tax twice on the same income, right? Now, DTR is giving a tax credit against the IHT liability on a state on the death of the individual, which is deducted after QSR. So when an individual is dying, okay, after you deduct the quick succession relief we have seen previously how it is done. You deduct DTR. DTR is lower of overseas tax suffered and your UK IHT payable on the overseas asset. Overseas tax suffered will be given in your exam, so you don't have to worry about it. Now, your UK IHT payable on the overseas asset is calculated like this: at the average state rate, known as AER, of IHT payable on the gross chargeable state after QSR. So first, IHT on the state after QSR divided by gross chargeable state value into value asset in state. Value of the overseas asset brought into the state is the value after you deduct the additional expenses. That is after you deduct the 5% of the expenses. Okay. Now let us do a question. We have two questions dealing with QSR and ETR. Illustration 1, test understanding 5. So let us first finish illustration 1. Calculate IHT payable as a result of the Pipa Luke's death. So Pipa Luke died on 15th August 2023. State value is 375. Rental property situated overseas valued at 60,000. Overseas IHT 18,000 was paid. Never lived in the property. State included 4% interest in quota shares. Inherited on the death of her mother on this date. Shares were the total holding of shares held by her mother on her death. At the time of her death, the shares were worth 50,000. And on the death, they were worth 150. IHT of 80,000 was paid on the total estate of 400 on her mother's death. No lifetime gives and left her entire estate to her son. Okay, so now let's quickly do this. Where do you start? Always gross chargeable state value. Do it here. Gross state value is given. The state is 375,000. Next, nil rate ban. Because no lifetime gives, so 325,000. Fully 50,000. Taxable amount is 50,000. Now IHT is on taxable amount at 40%. So 40% of 50 is 20,000. Next, less QSR. Remember first QSR, there's a working required for it. So we leave some space because 2 deaths occurred within 5 years, so QSR will be there. After that, you have less DTR because you paid overseas tax. There is a working 2 for it, which I have to deduct. And then IHT payable on his state, on P's state. That means Pipa Luke's state. So now let us do the working. Working 1 is QSR. First we'll finish with QSR. Okay, QSR method. I hope you don't forget the formula. Okay, you need the annual percentage. To know the annual percentage, you need to know the time between the death, the 2 deaths. So first it is the IHT. How much? IHT was paid on a total estate of 480,000 and the total estate was 400,000. On the value, at the time of her death, the shares were worth 50,000. You need this at the time of the first death. So all the 3 figures has been given for the fraction. Remember that fraction of QSR, do not forget that. So 80,000 IHT out of how much you have paid? 400 on 50,000. Remember you need the percentage. 20, 40, 50, 60. How much? And remember one more thing. The current value of the quoted share is not relevant. Okay, it is not relevant for QSR. Ignore it. All the information that is given might not be relevant for you. Okay, what is the appropriate percentage? You need the years. Check. Mother's death. Okay, so now this was 10 November 20. She inherited and he died 15th August 2023. So within 2 to 3 years. So because the death is within 2 to 3 years, that means from the legacy and the P's death within 2 to 3 years. So within 2 to 3 years, 1 to 2. Sorry, 0 to 1, 1 to 2, 2 to 3. So first it is 100%, 80%, 60%. This is how it works, no? The QC got this thing, so it's 60%. $6,000. QSR is what? 6,000. So we got one figure. Put here. Now DTR. Working to. DTR is a little easier than QSR. Okay. See, both are easier. It is just you have to know the formula and put the correct number. Okay. Now. DTR is lower of overseas tax offered. What is overseas tax offered? They have already given you how much? 18,000. Okay. 18,000 overseas tax offered. And what about UK IHT? You need the percentage, no? You need the rate of IHT, average state rate, AER. Just now we saw. So it is on the 60,000. See, the rental property situated overseas is 60,000. On the 60,000, you will pay UK IHT. So on the 60,000, you need a percentage here. That percentage you have to work out. That is known as AER, average state rate. Okay, so the rate of IHT on the state after QSR. If you see here, okay, for this you need to go here. So 20 minus 6 is 14,000. You need this figure for DTR. So 14,000. Put here. 14,000. This divide by how much? On the state after QSR. What is the value of the state? 375,000. This is the value of the state. So 14,000 or 375,000. You see? Into 100. It's coming up to 3.733%. This is the percent you have to put here. 3.733% of 60,000. So it's 2,240. So if you see 18,000 and 2,240, which one is lower? DTR is lower of the two. This one, 2,240. So 2,240. So if you deduct from 14,000, it's 11,760. This is your IHT. Okay. Now, we'll move on to test understanding 5. Compute the inheritance tax payable, showing clearly the amount payable by George's brother. You have to do some division here. Distribution you have to do to show how George's brother is paying. So George died on 5th Feb 24. A farm in Ethiopia rented out to tenant farmer 45. Other assets after liabilities 3,250. Farm was left to his brother and the residue was left to his niece. Additional cost of administrating the farm was 3,500. Death duties 6,000. George made no lifetime transfer. Okay. So now, where do you start? State valuation. Okay. You have to you have to add all the assets. Farm in Ethiopia. Remember, this is Ethiopia. It's a farm. Immediately one might think of APR and you will apply this. But think, APR is not on worldwide asset. It is only the one where it is situated in UK, EA, Channel Island or the Mainland Island. But this is situated in Ethiopia. So you will not get APR that is not situated in UK or EA or the Channel Island or the Island of Man. Be very careful. It's Ethiopia. It's a different country. So no what? No APR. What about VPR? You might say. What about VPR? BPR will also not be available on the farm because it's a tenanted farm. Tenanted farm is an investment asset, not a trading. So even BPR will not be available. This you have to write. So how much is the farm? 45,000. Straight away 45,000. Next, you have to deduct the cost less admin expenses. Okay, only up to 5% you can deduct. So 5% of 45,000 you can deduct. Which is 2250. 2250. But here if you see the admin expenses, you see here they are 3,500. But it is only restricted to 5% of the state value. That is the open market value. Open market value is 45,000. So 5% of that only you can deduct. 3,500 you can't deduct the full amount. Now 42,750. What's next? Other assets. Already liability was deducted and given the value. So you can take 303, 250. Add. You will get your gross chargeable state. 340. Sometimes they give you the gross chargeable state. Sometimes you have to find the gross chargeable state. Gross chargeable state. GCE. Now I'm going to find the IHT on the state value. So you start with gross chargeable state always. 346,000. Do not forget your nil rate band. No lifetime gift. So full 325,000 you will get. Taxable amount is 21,000. TA. So IHT is at 40%. 40% on 21,000, which is 8,400. Now less QSR. Sometimes you might not have any QSR. In this case, no QSR is 0 because no, they have not mentioned anything about two deaths. Information is not given. So IHT after Q, even if it is 0 QSR, you have to show 0. It's 8,400. You need this for double DTR. Now less DTR. There is a working for it because we have DTR. And what you will get is the IHT payable on George state. So we'll go to the working. Overseas tax suffered, okay? Overseas tax suffered, they've already given 6,000. Ethiopian death duties. Ethiopia. Lower of it. So 6,000 overseas. Remember, you need the amount IHT after QSR 8,400 because you want to find the average state rate. Okay. What is the value of the state? Gross chargeable is 346,000. There's two things you need into 100. Okay. Which is, you need this percentage actually, 2428%. Only for this percentage. So this percentage, 2428% into overseas property. What is the value of overseas property? This amount. After you deduct the admin expense, 42,750, not 45,000, 42,750. This is what you have to find out. That's why you need that amount IHT after QSR. Okay. Now it is 1038. This one is lower than 6,000. Overseas tax offered. So this is your DTR. 1038. 7362. This is your IHT. Remember they told how much Josh brother will pay. So you have to distribute. You have to allocate the IHT liability on the state. How will you do that? This part is over. Now we are allocating the IHT liability. Overseas property, okay? Taxes 1038 less DTR. You will pay, you will get this amount. So G. So G's brother will pay no tax. Residue is the niece. The residue is left with the niece. So the rest 7362. This IHT will be paid by the niece. G's niece. You can also get this amount like this. This is for other net assets. Okay. See here they have clearly mentioned. Farmer was left. The farm was left to his brother. Okay, and the residue was left to his niece. Residue means other asset. Other assets was left. That's why we have already got the DTR rate, the UK IHT. So UK IHT rate we got 2.428%. Don't waste time to calculate again. What is the other assets? 303,250. You will still get 7,362. Try it and check which G's niece will pay. The next section is payment of IHT. So from the overseas part, from double taxation relief, quick succession relief, now we are moving on to payment of IHT. It is the responsibility of the person liable to IHT to inform the HMRC of their relevant transfers of value. HMRC then will calculate the amount of IHT. You will have seen the payment due dates when studying IHT in tax. Even in ATX, these are important when you are advising our client. Okay, so that's why know the due date is very important. Why? Because your client will be very much interested in the due dates of the tax so that they can do tax planning. Next. Now, so it depends on the transfer and the due date. If the chargeable lifetime transfer is between 6th April and 30th September, due date is 30 April in the following year. If it is from 1st October to 5th April, it is 6 months after the end of the month in which the transfer is made. PET, chargeable as a result of death, 6 months after the month of the death. Additional tax due on CLT within 7 years before death, 6 months after the end of the month of death. State at death, earlier of 6 months after the end of the month of death or on delivery of the state accounts to HMRC, unless tax is paid in installments. And interest, remember the interest runs from 6 months from the end of the month of death. This table is very helpful for you. It's like a summary of all the due dates. Next, delivery of accounts. An account must be submitted to HMRC within 12 months of the end of the month of death. That means 1 year after the death. It should include all the details of state. And if you are making any lifetime transfer, account must be delivered within 12 months of the end of the month of transfer. Same, from the month of transfer, 1 year. If an account is submitted late, there will be a £100 penalty. And a further 100 penalty if the account is between 6 and 12 months late. If your IHT was less than 100 penalty, less than 100, the penalty would be equal to the amount outstanding. Let's say if your IHT is 50, penalty will be 50. Like that. It can't be more than that amount, right? Penalty can't be more than your IHT liability. So in that case, equal to the amount. If your account is over 12 months late, that means more than 1 year, there is an IHT due. See, sometimes your account will be 12 months late, but no IHT due, then no issue. But if there is an inheritance tax that is due and your account is 12 months late, there is a further penalty. Further means with that 100 you keep adding. It's not just 3,000. Okay, further penalty of up to 3,000. This could exceed the actual inheritance tax liability. Let's say your IHT liability is 1,000, but you're 12 months late. So your further penalty is 3,000. It could be more than that amount, right? Now, what are the penalties for error? The penalties for errors are in line with this charge for errors in an income tax return. So whatever you have studied in income tax, the assessment of an assessment rule and all applies for here. Now, the new thing is when you are paying by installments, you have to pay in 10 equal, it should be equal and it should be 10 equal annual installments. Remember, not for everything, but on some assets, inheritance tax are paid in installments. When is the starting date? Normal due date for payment. Asset must still be owned by the donee, and if it is sold, the whole of the outstanding installments becomes payable immediately. If you are selling the asset, whatever the installments, we will not wait for the installments. Outstanding installments will be paid at once. Now, so the tax must arise on any of the following. It could be on state at death, lifetime gifts within 7 years before death, lifetime gifts where donee has agreed to pay the tax arising. Assets to which the installment basis applies are this: land wherever situated, shares or securities in a company where the transferor controlled the company immediately before the transfer. You have to control the company. If you are not controlling the company, installment basis does not apply. The transferor, okay, that means more than 50% shares. Now, so two assets. Next, the third asset where you have to pay installments: shares or securities in an unquoted company where the tax arises on death and the amount of tax payable on all installment asset is at least 20% of the total tax payable on the state. This line is little bit tricky. You need calculation for this to understand. Then, shares of an unquoted company with a value in excess of 20,000, which represents 10% or more of the nominal value of company's share. Business or an interest in a business. So all this on installment basis. Note that a business or an interest in business will qualify for 100% BPR also. If so, then no tax is due. If the transfer did not qualify for BPR, okay, that means business has not been owned for 2 years, then what happens? Installment option could be considered for any tax due. Then again installment option is there. Now let us do question. Test your understanding 6. This one question is a very good question for one to test their knowledge of IHT from the following 3 lectures. Lecture 13, lecture 14, lecture 15. Whatever I have taught you till now in inheritance tax, if you want to test yourself whether you have understood the valuation of quoted shares, unquoted shares, unit trusts, related properties, then with residence, then death state, then giving charities, substantial legacies to charities, exempt legacies, residue legacy, all this, if you want to know whether you've understood, this question is enough for you. It's a very good question because it has all in it. Okay, so you can see there are 10 items given to you. Okay, 1 to 10, and you have been told to calculate the IHT and also state who will pay and who will suffer the tax. This is very important question from the point of your ATX also, because in ATX also very similar nature of question comes. Obviously they will not give you a big list like this, maybe 4 or 5 items or 2 to 3 items, but you should know how IHT is calculated on the state, when is the due date, and who will suffer the tax. Very important, 3 parts. So first part is calculation, that we can easily do. How will you do it? It's given in the order, just follow the chronological order. So your state will be prepared, 1 first, 2, then 3rd item, 4th item, 5th item, like that. Okay, so we'll read one by one. Now, this person died on 1st March 2024, leaving the state of the following. Okay, so now, first one, freehold house and land valued for probate at 630. This is about freehold house and land. This property was jointly owned by the deceased and his wife, who survived him as joint tenant. So just divide it by 2, and you see it is an exempt legacy. It is to this wife. So he will get an exemption because it is by spouse. So in the state, I have the answers already with me. Okay, so from the answer, I'm going to explain how it is done. So this saves a lot of time rather than me doing and inputting all the numbers one by one. Okay, it makes the lecture very lengthy, and also since it's a very big question, so I thought of doing this is a more efficient way. Okay, so the answer is like this, as you can see. Okay, our main focus is only on the first item. Okay, so first you will write the name of the person, then you will write chargeable state computation. Very important is the heading. You will get 1 mark for this, do not miss it. Then you have to write the pound. This you can do in Excel. This has to be done in Excel because you'll be doing it on a CV platform, not writing anymore. It's not a paper based. So in Excel there are two response options. One is word processor, the other one is Excel. You have to do it in Excel. It's calculation. So you have to label first one. You see, first item is presented first in the state, freehold house. You have to take the 50% because it's joint property. 50% of 630. Like this you have to show, and then it's 315. Show it inside because wherever you have to make some deduction or addition, show in the first column, inside column, and this is the outer column. The main result will be in the outer column. Then because there is a spouse exemption, anything to spouse is exempt, so 315 whole amount is exempt. So that's why it is 0. The first item is 0, as you can see here. So this is number 1. You don't have to write 1 2 3 4 like that, but I'm just showing you. So the first one is done from the list. First one is done from the list. Second item, overseas rental property. The moment you see overseas, you know you have to deal with DTR most of the time. Keep that in mind. Okay, it goes like that. And overseas you have to deduct expense up to 5% of open market value. There's two things you have to remember. So open with a sterling equivalent of 30,000 left to his daughter. Additional cost of administrating is 1,800 and debt duties payable overseas was 6,500. This is overseas tax suffered. This you need in DTR calculation. That is 6,500. Lower of UK IHT on the overseas property versus the 6,500. Whichever is lower is your DTR. And 5% of the expenses you have to take. 5% of what? 5% of this 30,000 you have to take. Only up to that amount you can deduct. That is 1,500. But your overseas expense they are saying is 1,800. No, it's restricted to this amount. 5% of 30,000. So that's what we have done here. You see, the second item. This is the second item, overseas property, 30,000. This is inside column. And then admin restricted to 5% of 30, 1,500. Then the total is 28,500. It's restricted to that. So this is the second item. Done. So it's very easy. It's not at all difficult, provided you know all these rules. These rules you have studied in previous lectures also and some in the current lecture. So 1 is done, 2 is done. Third, property situated in Cornwall valued at 440. This property has been main residence because main residence nil rate ban will be available later on when we do listed. So 440. 440, nothing to do with it. In the outer column, you can just write 440. You see, main residence in Cornwall. This is number 3, 440. Outside a column. No working required in the inside. Straight away. So it's straight. Some are very straight. Fourth one. Now, this is what you have studied in lecture 13. Lecture 14 actually, specific valuation, right, for quoted shares. So and quoted security. So this is 10,008% corporate bond. Corporate bond. This is a what? Quoted security. It's a bond. 82 to 86. Low price is 82, high price is 86. Interest is payable half yearly on 30th June. That means for 6 months. Remember, you have to include the next interest. Okay, with it. Same for the next one. 4 and 5 are same. 8,006% treasury stock, 72 74 x interest. Interest is payable half yearly. So you have to include that interest with it. This is quoted. Which method are we doing here? For quoted securities and shares. Lower off. Two method we studied. Quarter up and the average method. Average bargain price. There is no bargain price. Bargain price has not been given to you. So just do the quarter up of this two. Okay. Because if you try to do the average of this two also, You will still get the lower. The quarter up method will give you the lower method. We'll see how. See, first average we can easily do. Just 82 plus 86. Low and high divide by 2. It's 84. Where is quarter up? Okay, quarter up method is shown here. Quarter 3 up will give you a lower price. Average is giving you 84. Quarter up is 83. You see, this is the quarter up method. Multiplied with the 10,000. So 82, the lower price, plus 1/4 into high minus low into 10,000. So 8,300. That means it was 83 pence into 10,000. And yes, one more difference. You see, in the treasury stock, we are adding interest, but in the corporate bond, we are not adding the interest. See here. Why is it? Because in the fifth one, this was X interest. And here it is, they didn't mention anything. So because when they don't mention anything, you have to assume it's come interest. Interest has been already included there. We do not include interest. Only if it's X interest, we include the interest. That's why in the fourth one, we do not include interest. Fifth one, we include interest. So the method of calculation, both are same. This is also quarter up, 72 into 1/4 into 74 into 8,000. We add the 6% of 8,000 into 6 months for 6 months. That 240 interest we add with this and we get this. So this is for corporate bond, treasury stock fifth. Done. Now coming to the sixth one. Ordinary shares in Able Limited unquoted trading company worth 10,000. Shares has been owned for 5 years. 12% of the company's net assets are investment. What is it? Ordinary share, unquoted trading company, owned more than 2 years also. Unquoted trading company. So you will get BPR. Services, you see. So shares of 10,000. You will get a BPR of 100% of 10,000, but because you have some net investment of 12%, so only up to trading assets, only business assets, you will get the BPR. So 100 minus 12, the balance, remaining 88% only, you will get the BPR of 10,000. So 1,200 is the shares. Done. Now, seventh one, bank deposit, accrued interest. So both will be just included as it is, personal chattel just as it is, and death in service. Remember, when death in service is given, please read the policy. Death in service policy is expressed for the benefit of the spouse. It will be given. And death and funeral expenses, this is also will be given, deducted. So all this, no adjustment required, as it is copy paste. Bank account. So this they have already included the interest. They have added that 2,000 with 60. 635, that's why together they didn't show it separately. Okay, so 7 and 8 is here, 9 is here, and 10 is here. Chattel as it is, death in service, and they have deducted funeral expenses, it is allowed, and you get this from here onwards. Now anything you are giving to political charity, to spouse, and sorry, political party, spouse, and charity are exempt, known as exempt legacy. Okay, but you are only giving to spouse. You are not giving anything to charity or political party, qualifying political party. So the only exempt legacy here is spouse legacy. Anything to spouse is exempt, you have to deduct. So what have you given to spouse? For that we have to read here his will. So he is giving the overseas property to his daughter, 5,000 of each of the two grandchildren, he's giving 5,000, 5,000. Then 15,000 and personal chattel to his widow. A legacy of 15,000 and the personal chattel to his widow, and the residue is to the son. So you see, what are the exempt legacy? That is only to the spouse. Nothing to the daughter is exempt, nothing to the grandchildren is exempt, nothing to the son is exempt, but anything to the wife, to the widow is exempt. That is legacy of 15,000, personal chattel is 10,000, and one more thing he has left to the spouse is freehold house. Remember, jointly they have owned. The first one, this is why you have to, you can't forget that one. You have to link. So there are three: chattel, cash, death in service. I'm sorry. This has been already been deducted. I'm sorry. Spouse exemption has been applied here. Freehold house. So that's why you don't have to deduct here. But one, the last one, death in service. This this is for the benefit of spouse, the death in service, the 10th one. So that you have to deduct death in service. So 10,000, 15,000, 200,000. Deduct and you will get known as gross chargeable state. Very important. Only after you deduct anything to the exempt legacy, that is to spouse or charity or political party, you get your gross chargeable state. Again, gross chargeable state, very important. You need this gross chargeable here for your IHT, to calculate IHT. Next state is IHT. We are done with chargeable state computation. We got the value of the state 529010. From there, because we have one residence, first deduct 175,000 of residence nil rate ban. Then we deduct nil rate ban is 325, but why this reduced? There is a working for it because we made one lifetime gift. If you don't make any lifetime gift, full 325,000 you can deduct. But if you make any gift in the 7 years previously, that will be deducted. So we'll go to the working. You see, working are always presented after all the main tables. It's always at the end, after the main table. After you get a IHT payable on state, this is what the requirement asked you, the main. But you see how many steps you have to do, all the workings, you will get mark for each step. 1 mark for these, 1 mark for these, 1 mark for this, like that. One mark add, one mark will add up to 20 or 30 marks or 15 marks, like that. So working is at the end. So first is 325,000. From here, you made a lifetime gift. Okay, you made a lifetime gift of 139,000 to a discretionary trust. It's a CLT, chargeable lifetime transfer. Do not forget to deduct your 3,000 annual exemption. 3,000 current tax year, 3,000 previous tax year. So that will do. That will be deducted from 139. You see, that's why from 139 you deduct 3,000 of current year and 3,000 of the previous year annual exemption. Then you get an amount. This amount you deduct from the nil rate band. This is the nil rate band available, 192. So this 192 you go and write it here. This is why you need a working. Do not show the working here in the main table, crunch everything and make it very untidy. It should look very professional. And you get what is known as taxable amount. Remember, first gross chargeable state, deduct nil rate band, residence nil rate band if this is available. This might not be always available. Then only you will get your taxable amount. From your taxable amount, calculate IHT. Just apply 40% because nothing has been to the charity. Straight away 40% death tax on this value. So it's this amount. You don't have any quick succession relief because they did not mention about two death. So it is 0. Wherever it is 0, just write less QSR 0. Do not ignore it. After, because you need this value. IHT after QSR for your DTR. You are dependent on it. Now, you need your AER for your DTR. Just now we saw how to calculate DTR. You need this percentage. How this percentage is calculated? 64, this is IHT after DTR, divided by gross chargeable state. This is this 5290, this one. So always IHT after QSR divided by gross chargeable state value into 100. 12.25 is your percent. This percent you need here to apply to your overseas asset. This is the UK IHT. You are calculating UK IHT on your overseas asset. What is overseas asset? Go to point number 2. Go to point number 2. In your chargeable state itself, you have to go. Nowhere else. You see this value after you deduct your expense, not on 30,000. If you do that, you are making a mistake. Yes, overseas profit is 30,000, but after deducting expenses, you have to apply the percentage. So it's on 28,500. That's why I told you, do not look the question, go to the state immediately. 28,500. You see how every part is related to each one. Whatever you do above will be related below. So if you make a mistake here, your this will be wrong, your DTR will be wrong, everything goes wrong one after the other. You see, which is lower? This one is lower. Overseas was 6,500 already given in point number 2. So this is your DTR. This you deduct from here and you get your IHT payable on state. You have to write like that. IHT payable on state is 61313. That's it. You only have answered one part of the requirement, that is IHT payable. What about who paid and who suffered the tax? Yes, that comes next. See, remember, working right after the calculation is your working. Do not show working after these 2 points, okay? These two are separate requirements. And you have to clearly label like this, bold, in bold you have to write, and this has to be done in MS Word. Do not write it in Excel. In Excel, it's not a good place to type. Okay, once I will do a past paper of ATX and show you how to mention your workings in Excel in MS Word, how to reference. So IH payment, who will pay? Executors. IHT will be payable by the executors of state. Just one line enough. Do not elaborate too much. IHT suffered. Three people. One is overseas property. This goes to the daughter. Balance. Residue goes to the son. And granddaughters get 15,000 each. In between granddaughters get, two granddaughters get 15,000 each. They are the specific legacy. And one is of course the widow. Widow, spouse. So you have to talk about four people. The widow, the son, the two granddaughter, and the daughter in separate paragraphs. That's why there are three separate paragraphs. The first one is about daughter. So the IST on overseas property will be recovered from the daughter because it is to the daughter. Overseas property goes to the daughter. Who will suffer the IST on that overseas property? The daughter. Done. 1 mark. Second mark. What about the grandchildren? See, the grandchildren and the widow, no tax. No tax will be suffered from either the grandchildren or the widow. Why widow? Because widow we know it's an exam legatee. Why grandchildren? Because grandchildren is specific legatee. Specifically they have mentioned this will go to the grandchildren. This 15,000. So specific legatee and exam legatee, they suffer no tax. What about the balance of the IST then? Residue of the state. Whoever has the residue of the state, known as residuary legatee, that is the son in this case, will suffer the IST. So IST, the balance of the IST is always suffered by the residue legatee. That is in this case the son. Okay, so like this you have to answer. The next, from IHT payment, we are moving on to tax planning. Tax planning is so important for ATX, whether it is IHT, whether it is capital gain tax, whether it is income tax, whether it is VAT, whether it is corporation tax, whether it is ethics, whatever, tax planning is very important, whatever type of tax it is. This will be tested in your ATX. It is not there in tax because tax mostly is calculation based. You are supposed to calculate the right income tax, CGT, VAT, like that. But here, tax planning. Which type of gifts you have to gift? What do you have to give to the residue? Okay. What do you have to give to the specific legatee, like that? Now, planning in lifetime giving versus gifting on death. So we'll see from the point of tax which one is beneficial. So when you are advising a client on the advantages and disadvantages of lifetime gift versus giving assets on death, you should see the relationship between two taxes, IHT and CGT. See, in ATX, it's not one type of tax will be tested. When it is gift, it could be CGT also. Impact could be on CGT also. If you're gifting an asset, it's a CGT. There's an impact on two type of taxes, IHT and CGT. And advanced taxation, ATX, is testing your knowledge of the interaction of the multi taxes. Okay. So exam questions involving the timing of gifts could test your professional skills, such as your ability to analyze information and evaluate possible reliefs, your communication skills in explaining tax implications to your client using non-technical language, and also your commercial acumen in relation to advising on the most appropriate way to structure such gift. Now, so this table is very helpful. It's like a revision you can use, revision tool. Now, for lifetime gift, okay, no CGT if asset is an exempt asset. Very easy. But what about IHT? IHT on the other hand has no exempt assets for IHT. Everything is taxable. From the point of CGT, some assets are exempt assets, so they can escape CGT. But from the point of IHT, no assets can escape IHT. Everything is taxable. Now, CGT, chargeable gain or allowable loss arises. IHT, we follow the diminution in value concept, that is transfer of value. Calculated CGT calculated in normal way using market value of the asset gifted as consideration. IHT, if CLT, that is if chargeable lifetime transfer, IHT is payable during lifetime. If it's a pet, that means you're giving to a son or a daughter or a nephew, no tax payable during lifetime, but IHT might be payable if their death is within 7 years. If death is after 7 years, it is totally exempt. And it is valued at the time of gift. For CGT, we have gift holdover relief. See, all this we have covered when I finished CGT. When I was explaining a CGT, we covered all this, okay? Gift holdover relief is available for CGT. For example, if you are gifting a business asset or gift of any asset where there is an immediate charge to IHT, that is chargeable lifetime transfer. Gift holdover relief is applicable. And on the subsequent disposal of the asset by the donee, IHT relief may be available. When you see, this is from the point of CGT, okay? When you're having an impact on CGT and subsequently when you're disposing the asset by the donee, IHT relief may be available. For IHT, on the other hand, from the point of IHT, there are exemptions available on lifetime gifts. We have seen that. Marriage exemption is there, annual exemption is there, then small gift value, then BPR, APR is available in IHT. Business property relief and agricultural property relief. Available on both lifetime and death. Tapper relief is available if you are living more than 3 years after the gift. Residence nil rate ban not available on lifetime gifts but available on death. Right. This coming to the gift on death. From the point of CGT, no CGT to pay on death. Thank God. IHT, yes. Assets forms part of the death state. IHT payable on the market value of the asset at the date of death, unless the asset is covered by reliefs like BPR or APR, or is left to an exempt beneficiary like to a spouse, political party, or a charity. Next, residence nil rate ban available on main residence if it is passed directly to the descendants on death, like you are giving to your children or grandchildren. If you are giving to spouse or someone else, you will not get the residence nil rate ban. No other exemptions available on death state. See, you see, lifetime gift have so many exemptions. BPR, APR, like that. Even death state has, but death state has less exemptions compared to lifetime gifts. Tapper relief is also not available. Now, starting point for calculation. So, how do you start? It is important to appreciate that for lifetime gift, the starting point for computation of IHT and CGT are different. For IHT, lifetime transfers will be valued according to transfer of value. That also known as diminution in value. That means by how much amount the donor state has diminished in value because of the gift. And also you have to take the related property rules. Do not forget. For CGT, the value of the lifetime transfer, it is the value of the asset actually you have gifted. And related property concept do not apply to CGT, only to IHT. And if the asset gifted is a quoted share, different rules are applied to value the shares. If it's a quoted share, for CGT, the valuation rule is different. For IHT, valuation rules are different. So please follow both the lecture to know the differences. Do not confuse the two. Now let's do question. Illustration 2. So in illustration 2, it's about lifetime gift versus gifting assets on death. You have to calculate the transfer of value for IHT and deemed sale proceed for CGT. So A, So this is about a person owning 100,000 shares. 100 means 10% holding. Husband is owning 50,000 shares in a company. And on 31st July 2023 made a lifetime gift of 50,000 to her daughter. And based on the percentages, values has been given. So remember, for IHT related properties there. So husband's part will be related. So, so the wife owns 100,000, that means 10% holding. Husband owns half of it. Half of 100 is 50. So half of 10% holding will be 5% holding. So 10 and 5, 15% holding before the gift. So 15% holding means price is 13. Okay. So you only have to take the 100,000 shares of the, because it's related. 100,000 into 15%. It's 13. This is based on 15% holding. You have to take the husband's holding as well as the wife's holding because it's related. And the price is 13. But you have to place it on the 100,000 shares because the donor is the wife. So it's 1,300,000 after the gift. Gift is of 50,000. 50,000 means 5%. That means from 15 you are giving away 5%. So after gift it's 10% holding. So based on 10% holding the price is 10. And how much you are giving? 50,000 shares. So 50,000 into 10, which is 500,000, which is 800,000. So this is the transfer of value for IHT purpose. For B, it is the gift of the 5% shareholding that has been made. So what is the gift of 5% shareholding? The price is 8 into 50,000 shares. So 50,000 into 8 is 400,000. For CGT purpose, it's 400. Next is IHT deduction for CGT. As I've mentioned this on the table, right? For lifetime gift, if you are making subsequent disposal by donee, whatever the IHT they have paid, they can deduct. So when an asset is gifted to another individual during the donor's lifetime, both IHT and CGT considered, where both gift holdover relief is claimed on the gift and IHT is paid in relation to the gift, then see, both has to be there. Gift holdover relief has to be claimed, IHT has to be paid. If both are there, any IHT paid, then you can deduct. When you're calculating chargeable gain, from there you can deduct that IHT payable when the donee is disposing that asset subsequently. Now let us do a question on that. Illustration 3, IHT payable. Okay, it's also lifetime versus gifting assets on death. Calculate the CGT liability that will arise upon Joe's disposal of the business property on 31st August 2023. So, 31st December 2020, Yas made a gift of a business property, not in relation to the disposal of the entire business, worth 341, to her daughter. Yas and Joe made a joint gift holdover relief to defer the capital gain of 103 arising on the gift. That means, what did they claim? Gift relief. Assuming the business property did not qualify for BPR and the IHT annual exemptions had already been used, Yas died on 30th April 2023, having made no other lifetime transfer except those to use her annual exemptions. Joe sold the business property for 368 on 31st August 2023. Joe is a high rate taxpayer and makes no other disposal in the tax year 23-24. So remember, from your CGT liability, because they have claimed the gift relief and the donee sells the business property, there's a subsequent disposal. That means he must have paid IHT. And that IHT has to be deducted from CGT. So before calculating CGT liability, you have to calculate the IHT payable, because you have to deduct that IHT payable from CGT liability, because the pet becomes chargeable. You see, he dies within 7 years. Yes, from the date of gift. 31st December 20 and he dies on 30th April 2023. So there, the pet, even if he's gifting it to our daughter, it's a pet, right? It's a pet. Pet becomes chargeable. So because pet becomes chargeable means you have paid IHT. That's why you have to first calculate the IHT on that pet before calculating CGT liability. So now IHT payable during lifetime. It is transfer of value first. What is the value of the gift? 341,000. Then what about BPR and annual exemption? Here you don't have to deduct. They have already told. Annual exemptions already used. They do not qualify for BPR. Okay, so they are not there. Usually because this is a business property, you will get a BPR. But here they say it's not applicable. So no BPR, no annual exemption. But still, you just can't write transfer of value. You have to write that BPR is not available. You will get marks for it. Because normally is applicable. When something is normally applicable for BPR and you are not getting BPR, you have to write reasons why BPR is not available. But if something is not applicable for BPR at all, the nature asset is not a business asset, you don't have to write the BPR. BPR not applicable per question. Okay, not applicable per question. Same annual exemption also. It is not available in the question. So transfer of value is 341,000. BPR is 0. Annual exemption is 0. For that 0, 0 you are going to get marks. Because normally we deduct annual exemption from transfer of value. So 341,000. Now, lifetime, see, we will calculate. This is potentially exempt. Potentially. Because we are calculating in the lifetime. Lifetime, there is no IHT on pet. It's a pet. But, so the lifetime IHT DO, it's a pet. For lifetime, it is 0. But we still need this. Now, come to the next. IHT payable when the donor is dying. At that time, this becomes chargeable. During the donor's lifetime, no tax. But you need this amount to carry forward. That's why you calculate and keep it during lifetime. During lifetime, you have to do this. Now, gross chargeable amount. It's done. 341,000. Nil rate ban. No residence nil rate ban. No lifetime gift, so full 325,000 nil rate ban is applicable. They have already mentioned that. They will mention if lifetime gift is there or not. So taxable amount is 16,000. Taxable amount. Now, so this will be taxed at 40%. 6,400. IHT. This is IHT due on death. But you might get a taper relief. If you are surviving more than 3 years but less than 7 years. 3 to 7 you will get the taper relief. If you are surviving less than 3 years, no taper relief. So we'll see whether taper relief is there or not. He is giving the gift on 31st December 20, dying on 30th April 2023. Did not complete 3 years. It's less than 3 years. So no taper relief. No taper relief. As it's less than 3 years, You can write the 0. Taper relief will be 0 in this case. And remember, any IHT paid during lifetime you have to deduct and death. Because this is a pet, you do not pay any IHT in lifetime, but you have to write it. IHT paid in lifetime. This you have to write and show it is 0 because it's a pet. You have to write it's a pet. That's why it is 0. For that you are going to get marks. So it's simply nothing but 6,400. IHT payable on death. Is 6,400. Now we are coming to the CGT liability. Finally. So what is the sale proceed? I'm just using the initials, okay? Let's just understand. You are selling it for 368,000. Jaw, the sun. 368,000 is the sale proceed. Remember the base cost of asset. This is CGT. Come back to your CGT from IHT. Move back. This will only come if you are very thorough with your CGT. Okay, base cost of asset to jaw. Now, market value at the date of gift. At date of gift. What was the market value at the date of gift? 341,000. This one, isn't it? This 341,000 he has given to our daughter. That will remain as it is. 341,000. Next, gift holdover relief. Gift relief. It's a rollover. So gift relief will be deducted from this. How much? How much is the gift relief? 103. They have deferred the gain. 103. 103 gain was arising on the gift. They made a gift relief. So this much they have deferred the gain. Which is 238,000 from 368 you have to deduct. 130,000. Now you will deduct your IHT. Now is the time you have to deduct your IHT that you have paid on pet less IHT on pet. How much? 6,400. This is why you need your IHT before CGT. So 1, 2, 3, 600. What is this? Do not forget capital gain tax, chargeable gain. From chargeable gain, what do you deduct? Annual exempt amount. Annual exempt amount for CGT. How much? 3,000. 3,000 is for IHT. 6,000 straight away for CGT. Do not forget this. 117,600. What is this? Known as taxable gain. And from taxable gain, you are a high rate taxpayer. They have already given. And this is not a residential property. So CGT is 20%. 23. 5. 20. This is your CGT, capital gain tax. This is what they have asked. It will be payable by Joe, the son. Next, IHT planning. It's important for an individual to plan lifetime gifts to be tax efficient and so to make a will that individual state is distributed in a tax efficient way. There are a number of tax planning measures that can reduce your IHT and it is divided into 3 areas. First, lifetime tax planning. Second, death estate planning. Third, married couples and civil partners planning. So first, we'll go through the lifetime and death estate and married couples in detail. Overall objective of all the IHT tax planning measures are minimize the amount of tax payable, maximize the inheritance of the next generation. Two things. Now, first, lifetime tax planning. So, IHT planning during an individual's lifetime involves making gifts of wealth as early as possible. Advantages of lifetime gifts. Advantages of lifetime gifts. You have to know these advantages and disadvantages, because when we are advising to a client, it's not only calculation part you have to show or how much tax you are saving, but also you should be able to write the other advantages. If a gift is a pet, no IHT will be payable if the donor survives 7 years. If a gift is a chargeable lifetime transfer, tax will be calculated at 20% and no additional IHT will be payable if the donor survives the 7 years. If the donor does not survive 7 years, you will get TAPA relief after 3 years. So these are the 3 advantages of lifetime gifts. Next, fourth advantage. A lifetime gift is valued at the time of gift. That means any appreciation in value of the asset is not taken into account. This locks the value. That means the value is frozen. So any increase in value up to the date of the death will not be taxed. Fifth advantage, if the value of the asset decreases, you will get a fall in value relief. This fall in value relief I have covered in my previous lecture, lecture 14. So fall in value relief may be available to reduce your chargeable amount on death. Sixth advantage, exemptions such as normal gifts out of income, small gifts, marriage and annual exemptions may reduce or eliminate the value of a lifetime gift. We have covered all these exemptions in lecture 13. So you can always go back to lecture 13 and go through these exemptions in case you forgot how it works, because it's always a good way to go back and practice. Then, however, remember the CGT implications. There are 6 advantages from IHT point, but CGT implications are there. The CGT may be payable on the lifetime gifts of chargeable assets, but CGT will not be payable on assets held at the date of death. An individual should therefore be advised to make lifetime gift of assets. So make gift of lifetime assets of those assets that appreciate in value and will not generate significant liability to CGT. That means CGT will not arise so much, and assets that appreciate in value better to make it as a lifetime gift. For example, gift assets that are exempt from CGT or assets that are deferred or exempt by available CGT reliefs like rollover relief or gift relief. Next, there are no IHT savings in gifting assets that qualify for BPR or APR at 100%. If you gift assets that qualify for BPR or APR at 100%, there is no IHT saving you can do. Now, estate planning. The next is estate planning. An individual should be advised to draft a tax efficient will, ensuring that you utilize your nil residence band and nil rate band fully, and unnecessary charges to IHT will not incur on death. You have to plan your will in such a way. Next, skipping a generation. That means where you are leaving a property to your grandchildren rather than children. So you are missing one generation out. It is advantageous in this case to miss out a generation. That means leave the property to grandchildren instead of your children. Why? There are some advantages to it, but there are no immediate saving of IHT. But a charge to IHT on the death of the children will be avoided. Later advantages are there, but immediate savings of IHT is not there. Such a planning is particularly relevant if the children already have sufficient property in their own right. Let's say you are a parent, grandparent, your children already have sufficient property to look after themselves. They have their own property. So better to give to the grandchildren so that children can skip the IHT. They do not have to pay any IHT. Right? Now, the income tax benefit of this may also see. Now the third tax is coming into the picture. IHT CGT income tax. The income tax benefit is this. If the parent sets up a source of income for a child, parent will be assessed on the income unless the amount is below 100. This we have covered in income tax. However, if the grandparent set up the source of income, then the income will be on the child. Whatever the amount, it will be on the child only. It will not fall on the grandparent. But if it's from parent to children, whatever the income of child, if it is managed by the parent, it will fall. The income tax will be on the parent. They have to pay. Now, second, married couples and civil partner. You have to make elections so that you transfer the unused residence nil rate ban or nil rate ban to a widow or widower. And you can make elections where one spouse is UK domicile, the other one is non-UK domicile. The non-UK domicile can make the election to be treated as UK domicile if you cease beneficial. You have to carefully choose which assets to gift to your spouse. Make the use of deed of variation to minimize IHT on death. Later on, we'll go through this deed of variation. Now, where the couple owns assets that qualify for BPR or APR, you should not leave these assets to the spouse. Because anyway, whatever you're giving to the spouse will be covered by your inter-spouse exemption. Everything is exempted. Anything given to the spouse will be exempted. So in that case, benefit of BPR and APR you will lose, you will waste it. So rather transfer those assets to spouse which will not qualify for BPR or APR, so that you can get the benefit of spouse exemption as well as BPR and APR also. So therefore, BPR and APR assets should be left to non-exempt beneficiaries, like your son or your daughter or your granddaughter, not to your spouse. As a result, the benefit of both the relief and the interspouse exemption will be available to reduce the value of the chargeable state. Now let us do a question. Illustration 4. In illustration 4, you are to advise John and her children of tax planning measure they could take in order to minimize the impact of IHT. NRB for this year was 312. Assume the current rate will apply when John dies. Okay. So now, John is 67 years old, was widowed on the death of her husband on this date, 21st June 2008. She has 6 grandchildren. Husband had a chargeable estate of 800, no lifetime transfer, and this property was entirely left to John. John now has a estate value of 1,050,000, which will pass to her 2 children when she dies. 500 of this relates to family home. John's children are both quite wealthy and are concerned about the IHT liability which will arise upon John's death. John had made no lifetime transfer. So now, on John's husband's death. First, we'll talk about on husband's death. What is the impact? There are 3 impacts. 1, 2, 3. So this is the solution. First, remember the transfer to John. The wife is an exempt transfer. That's why no IHT is due on his estate, on the wife. And none of his nil rate ban or residence nil rate ban was utilized. That means 100% was unutilized. Okay. Which she can give to, which will be transferred to the wife. That is Joan. Now, we'll calculate Joan's death state. It starts with his gross chargeable estate. This is the value. Because he had this thing, family home which he give to his children, residence nil rate ban will be applicable, 175. The other 175 will be transferred from her husband, 175. Okay. One is at the wife's death, the other one is at the husband's death. And it is transferred to the surviving spouse. 2 residence nil rate ban and 2 nil rate ban. So this is the taxable amount. And you get 40% and this is the IHT. This will be paid by the executor, borne by John's children. This is wife's death, not the husband's death. I'm sorry. John's death, you have to calculate the death state. Now, you have to advise. Okay. And one more thing. See, they told about nil rate ban is 312 at this date, right? Husband's death. But the percentage of 100% applies to this 325,000. That is the current NRB. Okay. The It might be 312, but the amount unused was for 100%. So this percentage is applied to the current NRB, which is 325,000, not 312. Okay. And John's executor must claim the transferred NRB on the submission of the IHT return within 2 years from her death. So this is under notes. This is just for you to understand. You don't have to write it. It's not a part of an answer. Why it was 100% of 325 for that. Now comes the advice. How many advices are there? 3. So these are the 3 advice. 1, 2, and 3. Wait. Okay. Now. So let's read the 3 advice. See, one is their children are wealthy. Children were already wealthy. So better to give it to grandchildren. Right? Rather than giving it to children, leave the state. John could leave her state to grandchildren. So even though this will not save IHT on John's death state, by skipping a generation, it's about skipping a generation. What happens? IHT on the same wealth will not be due until the transfers are made by the grandchildren. Until the grandchildren do not make the transfer, IHT will not be payable. Okay, and also residence nil rate ban will be available if John leaves the family home to her grandchildren as their still direct descendants. They're still direct descendants. Number 2, if John dies without considering the above, her children could alter the John's will by a deed of variation. Next is deed of variation. Within 2 years. Within 2 years, they can still change the deed from John's death. Third, John should also consider making lifetime gifts to her grandchildren to utilize the annual exempt and also to benefit from the advantages of making pet. Okay, so these are the 3 advices. Deed of variation. It is possible to change the terms of an individual's will after the individual's death by entering into a deed of variation. In practice, the main reason for entering into a deed of variation is to redistribute the deceased estate on a fair basis. However, a deed of variation can also be used for effective tax planning tool for IHT and CGT purpose. Now, changes can be made to make the provisions of a will more tax efficient in the following situations. Number 1, where the estate has been left to children, okay, who has sufficient property. So now, part of the estate could be diverted to grandchildren instead. Next, family home could be diverted to direct descendants, could be given to children or grandchildren to take the advantage of the residence nil rate ban. Next, amounts left to charity could be increased to 10% or more of the baseline stage so that your whole state is taxable at 36% rather than 40%. And however, the revised terms of a will under a deed of variation will only be effective for tax purpose if the following conditions are satisfied. Number 1 condition, deed has to be in writing and it has to be signed by all the beneficiaries that are affected by the deed. Next, not be made for any consideration. Third, must be executed within 2 years of death and it must state that it is intended to be effective for tax, IHT or CGT purposes. Now, without a statement saying that the variation is effective for CGT purpose, a transfer will be deemed to take place at market value. between the person who first inherited the asset and the person who will subsequently receive it. If there has been an increase in value since death, this will give rise to a chargeable gain at this point in time. Okay, be very careful of this point. If the gain arising is covered by annual exemption amount or capital losses, then it will be advantageous to omit the statement, making the variation effective for CGT. If this is not the case, executors should ensure that such a statement is included. So you have to know when it's advantageous to include the statement and when it is not. Now, let us do question. Test your understanding 7. In test your understanding 7, A. Assuming deed of variation is made after Faisal's death, calculate the minimum increase in the donation to charity that is required in order that Faisal's state qualifies for the reduced rate of IHT. B. Calculate the net increase in the state available for Faisal's son as a result of making this increased donation. Okay, so Faisal died on 8th August 2023, leaving his entire estate to his son. State is valued 500,000 after deducting exemptions and reliefs, including a donation to charity of 18,000. Faisal made no lifetime gifts, did not own any residential property. That means nil rate ban is 325 and no residence nil rate ban. So now, first let's do part A. Okay, what do you need? Where do you start? Baseline amount. What do you need? Baseline amount. You have to calculate an item known as baseline amount. This terms, how do you calculate baseline amount? Net state. After charitable legacy. Okay, it is the net state. That means after you have taken the charitable legacy into the picture. What is it? 500,000. Remember, they told the state is valued at 500 after deducting exemptions and reliefs, including a donation to charity. It is already included. After they have done everything, state is 500,000. You start from here. This is the first point. Next, you deduct nil rate bat. How much? No lifetime gives a full 325,000. What is known as taxable state? You need taxable state. What is it? 175,000. Now from the taxable state, add back. See, you have deducted your charitable legacy here to get the net state. Now add back the charitable legacy. How much was the charitable legacy? 18,000. Now you get your baseline. What you get is your baseline amount, 193,000. This is known as baseline amount, 193. With this, take 10% of this amount, which is 19300, 19,300. So to get the reduced rate of 36%, your donation to the charity should be 19,300 and above. Currently, your charity is 18,000. So how much it should be increased? 19,300 minus 18,000. 1,300 should be increased by 1,300. This is what they asked you. How much it should be increased by? Read the requirements again. Calculate the minimum increase, minimum in the donation to charity should be increased by 1,300. Coming to part B. Net increase in the state because of this 1,300. Okay. So whatever you get 1,300, cost of extra charitable donation, there's a cost. So cost of extra charitable donation CD is 1,300. It's a cost, put it in bracket. Remember, when you are finding the net increase, it's just the impact, not the full state value. Now, without this extra charitable donation, okay, what would have been your IHT? So IHT, okay, IHT on the original taxable state. That means without extra charitable donation. I'm writing CD for charitable donation. Would be 40% off. How much? Faisal died. Okay, so it's 40%. Without this, it would be 40%. IHT would be at 40%. On which amount? Taxable state is 175,000. This amount. How much? 70,000. Okay. IHT on revised taxable state. Next. Would be what? 36%, isn't it? On the difference. Before it was 175,000. Now your charitable, your state will reduce, will fall by that extra 1,300 donation that you are making. Because charitable donation is an exempt legacy. So it will fall from your taxable state, which is 62,532. The difference 7468. 70,000 minus 62,532 is 7468. So with this you deduct 1,300. 6168. This is your net increase in state for Faisal's son. Net increase in state for Faisal's son. The last part of this lecture, anti-avoidance rule, gift with reservation. This is also new for ATX. This has a high chance of appearing in your ATX exam. A gift with reservation of benefit is a lifetime gift where legal ownership of the asset is transferred but the donor retains some benefit of the asset gifted. Examples. You are gifting a house but donor is still staying in that house. Gifting of shares but donor still gets the right to future dividends. Gifting of assets into a trust but donor is the beneficiary of the trust. So for this, there are some special anti-avoidance rule apply to ensure that the gifts do not escape the IHT charge. Now, how do you treat it? When an asset is gifted but the donor retains the right to use it without the payment of full rent, it falls into this category, gift with reservation. Two rules are there. One, reservation is still in place when the donor dies. Second, reservation still in place when the donor dies. Okay. Now, original gift. So there has been a mistake. The second column is reservation lifted before the donor dies. Okay. Now, so if the reservation is still in place when the donor dies, original gift is gift with reservation. It could be pet or CLT. Then, at market value of asset on date of gift. If it's lifted, original gift could be given with reservation. Market value of asset on the date of gift. First one is same. Coming to the second one, on the death of donor. Donor still uses the asset at the date of death, so you have to put the asset in the donor's state. Market value on the date of death. But in the second scenario, where the reservation are lifted, that means donor is no longer using the asset, it's a pet. It will be considered pet at that time, and you have to use the market value of asset on the day the reservation is lifted. Then, for both, there is a gift with reservation, potential giver. So a gift with reservation gives the rise to a double charge to IHT. Therefore, HMRC has the right to charge the highest tax liability arising from event 1 or 2. We'll see which is giving the highest. Is it event 1 or 2? Known as double charges relief. Now, how do you treat? So, usually including the asset in the state or treating as a pet when the reservation is lifted gives the higher IHT charge. Why? Capital assets normally appreciate in value, and no annual exemptions are also there on that state or against the pet. Any tax is payable. Any tax arising is payable by the legal owner of the asset, the donor. If the gift with reservation is a residential property that the donor lived in, there will be a residence nil rate ban that will be available where the property is included in the deceased state. Now let us do a question. This is the last question of this lecture, illustration 5, gift with reservation. Calculate IHT payable on Priya's death. Priya gave her a house to her son Sushil on 1st April 18 when it was worth 360. No previous lifetime gift. Priya continued to live in the house and paid no rent to Sushil. Priya died on 1st Jan 2024, leaving the state of 700 excluding the house to Sushil. At this day, the house was worth 500,000. Okay, so now remember 1 and 2, whichever is higher, it's the gift with reservation. So first we'll treat it's to a son, so it's not a chargeable lifetime transfer, it's a pet. Okay, the solution is here. Let's go through the solution. So first we'll treat the gift as a pet. When it's a pet, transfer of value is 360,000. So we start with 360 minus the annual exemptions of the current and the previous year, 3,000, 3,000, and we get this. Nil rate band is 325 since no lifetime gift, and we get the taxable amount taxed at 40%, and we'll see the taper relief because he survived more than 3 years but died within 7 years. So from 1st of April to 18 to 1st Jan 2024, it's within 5 to 6 years. So the taper relief is 60%. So 60% of this amount is this, and this will be your IHT payable on death. Now, coming to the death state. So this is treat the gift as a pet. 1st April 2018. Date is very important. We are still in 1, okay? This is 1. And then 1st Jan 2024 is the death state. We are still under 1 only. So on that day, the value is 700. Nil rate band again is 325. But remember, there was a gift that was made 7 years before death. So that gift will utilize this nil rate band. That is no nil rate band is available on death. Why? It's 354 more than 325. Where did you get the 354? This gift. This gift was made. So taxable amount is fully 700. It's at 40%. And this you add with this. Lifetime you paid 4640. And additional tax is 280. So total tax is this. In the first scenario. Coming to the second scenario. Treat the gift as a part of death state. This is number 2. Whichever is higher, that will be your IHT. So death state only on one date. This date. Okay. So now, here, the death state is different. Leaving the state of 700. With this 700, you have to add this 500,000. In the second scenario. When you are treating the gift as a part of death state. That 500 you have to include in the death state. So that's why it's 1.2 million. You will get a residence nil rate ban because you are giving it to a son. So this you will deduct. Full nil rate ban you will get. It's available. Okay. Now, then we are moving to taxable amount. This is at 40%, 280,000. So this is 280,000 and this one is under second scenario is 280. First scenario IHT is 284,640. So IHT will choose this amount. HMRC will choose the higher of the two. So 284,640. This is how you have to do gift with reservation IHT calculation. Always the higher of 1 and 2. In the second one, we are just including this 500,000 in the state and also we are giving the residence nil rate ban. That's it. Now, there is an exceptions to this gift with reservation rules. And this is the last part. With this, we are going to summarize the lecture. Following gifts will not be treated as gift with reservation, where full consideration is paid for the benefit derived from the user property. For example, house has been given away, but donor still living in it, but he's paying the commercial rent for living in that house. Then it will not be given with reservation rule. Rent below the commercial rate will not accept the transaction from the rules. Where the circumstances of the donor have changed in a way that was not foreseen at the time of gift. The example of the second one is situation where a house has been given away and donor moves out of the house. Then at the later date, donor becomes ill and he returns to the house and starts staying with the family because the donor needs to be cared for. This will not fall under the gift with reservation rule because at the time when the donor left the house, he did not know the situation will change and he has to come back and stay. That's it. Now, the summary of the anti-avoidance rule. So, gift with reservation means legal ownership is transferred but benefit is retained by the donor. It is treated as a part of state at the death because it's still with the donor. Donor is benefiting. HMRC will insist on the higher total IHT payable, assuming lifetime gift occurred and the state not in state. IHT always paid by the donee if it's given with reservation and it can be avoided if the donor pays the market rate rent. Now, the whole summary of the lecture. So here, IHT focuses on other areas that was not covered in lecture 13 and 14. Overseas aspect, the domicile status and the deemed domicile, and the DTR, that is double taxation relief. Then how the payment of IHT is done, the normal due dates, 10 equal installments, tax planning, variation of terms of will, lifetime gift versus gift on death. So you can vary the will if it's effective tax planning tool subject to some conditions. This must be executed within 2 years from the date of death. It has to be in writing. It should be signed voluntarily by all beneficiaries. It should not be made for valuable consideration and it should state that the deed is effective for tax purpose. Then lifetime planning, you have to see the CGT and IHT considerations both. You have to maximize exemptions and reliefs. You have to make a choice of the asset gifted. Then second, estate planning, where you skip a generation and leave your assets to your grandchildren rather than children. Legacies to charity, which will reduce your rate from 40 to 36%, and married couples planning, where you give to your spouse those assets which do not benefit for BPR or APR because they exempt legacies. Next, anti-avoidance, gift with reservation. So with this, I have finished the IHT in total. Lecture 13, 14, 15 strictly follows IHT. Please go back and go to your revision kit and start doing questions. As you know, your December exams are approaching. It's just a month left and Also watch my income tax lectures and CGT, inheritance tax. So 3 taxes are covered. I finished. The next lecture will be focusing on a new area. So do not forget to subscribe to my channel if you haven't, and do share the content with your friends. Thank you for watching.